Good morning. Today is Tuesday, January 6, 2026, a brand new year. My name's Joe Terril. I'm president of Terril & Company, independent wealth managers headquartered in St. Louis, Missouri. And with me today, as most of you know, but I'll quickly introduce our investment committee. Kristen Wood sitting to my left, Russ Phillips to my right, Dave Carter, and Bill Newbold, and we'll give a quick update on what we're thinking as we head into the new year. With that said, let me start by answering a question that we're fielding from quite a few people. The recent action in Venezuela by the administration, we do not expect to have a major influence on our stock market, our interest rate environment, inflation, etc. What eventually is going to happen, us and everybody else doesn't know, but we don't think it's going to, and it certainly hasn't so far had any influence on investment markets or the economy, and we don't think it will. So with that said, I want to switch to chatting about the economy, which continues to be strong. But Kristen, let me turn to you because you and your family are out there in the real world. Talk a little bit about what you see in the economy.
Yeah, I think the recent GDP figures on the economy was strong. It's hard to find a weakness there. And the growth of the money supply is measured by them too, has picked up. I think it would be unusual to see a recession with the money supply growing. I think people are still out spending lots of money.
Kristen, your family, as I mentioned, do you see, what do you see just as that type of indicator? Stores, restaurants, car sales, what do you see there?
I see restaurants are booming. I have plenty of neighbors, they got new cars for Christmas. People are still spending money, especially in these months, you know, the winter months. I think people are going to be spending more money.
I'm going to turn now on the economy to Russ Phillips. Russ, you tend to look more statistically at numbers. Talk about the economy a little bit.
So, supporting what Kristen said, if you look at the Atlanta Fed GDP number, this is an estimate for the fourth quarter. I think it was reported yesterday at plus 2.7. The actual third quarter number came in at 4.3. Second quarter number was about 3.8. So to Kristen's point, the economy is strong. If you have a job, you're spending money, you feel good about that job. And another thing to Kristen's point about auto sales, Joe, 16.02 million auto sales in the month of December. The estimate was for about 15.8, and I think November was 15.6. People are definitely buying new cars, as Kristen said.
Just because, and I'm going to turn to you, Bill, in a minute now to talk about stock prices, but I just want to assure our viewers, just because the economy is strong doesn't follow through that therefore stock prices are automatically going to be strong. Stock prices can vary from what the economy's doing, although it is a good indication to watch the economy. But Bill, let's talk about our outlook for stock prices.
Sure. So thanks, Joe. 2025 was a very good year for stocks with the S&P up 16%. And the earnings growth outlook for this year, looks solid. The market's factoring in about 12%. Earnings growth for 2026, valuations remain extremely high. In fact, still at all-time highs. So, you have to be disciplined. We spend a lot of time looking for stocks that have been overlooked or that are cheap relative to the rest of the market. So our mantra has been very consistent over the last year. And names that we found value in 2 to 3 years ago that nobody cared about, a name like Citigroup is now a market darling. They can't say enough about it. When we bought it, nobody cared about it. So we traditionally look for names that have been kind of overlooked or that have some problems that they're going to be able to fix. But, you know, it's very likely that we'll be opportunistic and take some profits
Bill,
as the market continues to trend higher.
3M fits that category too.
Sure.
When we started buying it, people were down on it and had reasons why they didn't want that.
Right, right.
Certainly Warner Brothers Discovery, that was a big winner for us last
Mhm.
year, was one nobody wanted, that we felt the value of the sum of the parts was worth
Sure.
much more than what the stock was selling for. So the key there, though, is finding ones that are cheap. Some of them are cheap for a good reason.
Right.
And we pass on them.
Mhm.
But others that we think that's not a valid reason of why that stock is selling at a very modest multiple.
Sure. I mean, we look at the business models at these companies and we really try and dig into the reasons why they've been left behind. And good underlying fundamental businesses with good intrinsic value are the kind of names we look for. So Warner Brothers was a great example, 3M, you know, and all of these companies have really kind of restructured themselves, they've turned things around, and we look for those types of stories where we can find hidden value.
We look for income, Joe. I mean, I think I want to stress
That's
that,
true.
as Kristen was saying, where clients are spending money. We do have income as a key component of our equity, not just our fixed holdings, but
Sure.
our equity holdings. And one other point I wanted to make about the prognosticators, Joe, you mentioned just because the economy's strong doesn't mean stocks are going to be strong. As our clients know, in 2025, all the prognosticators said there would be a recession. Guess what? There wasn't one. The one thing as it relates to stocks that concerns at least me a little bit is the fact that all the prognosticators are positive on everything. They're positive, as Bill said, on earnings. They're positive that inflation's going to be contained. Interest rates are always, they're going back to zero. I'm saying that facetiously, but they're coming down. All the prognosticators are positive on everything this year, so we know that's probably what won't happen.
Well, and I think part of that is the expectation that AI is bringing to the business world and the economy, and the market is pricing in a revolution in efficiency and productivity, not an evolution, not baby steps. They're pricing in a massive change, and that usually does not happen.
At least not in the beginning.
Yes.
You have a period of it, and then you have to have a
And
period.
so
to
there's some
settle.
expectations being built in that segment.
Right.
Well, certainly, everyone being so positive about everything is why we are fundamentally cautious at the moment. We bought a little bit of Toast, speaking of a company that we have a lot of confidence in, that had a pullback in the first trading days of January. But in general, we will probably, Bill, confirm this for me, be looking to take profits in some of the things we bought 2 or 3 years
Sure.
ago that are now no longer bargains. The prices are up to an elevated level where for us it's, let's sell it, go on down the road and find something else.
Sure. No, I mean, that,
Okay, Bill, Russ, thanks, Dave. Real quick, interest rates, chat real quickly.
Pretty
about-
boring right now. Market is expecting at least two cuts in 26 with the Fed funds. The 10-year bond, which is a key rate that we look at, is stubbornly, 4.15 to 4.20 and not trading down. We don't see that. We don't see that rate going down with what's going on in the economy. UBS yesterday sold $3 billion worth of a long-term preferred issue. They received $21 billion in orders for that. That is, that shows you the demand for fixed income right now, which is crazy. But We think rates are gonna be higher for longer, even if the front end is priced lower with the Fed.
Dave, thank you. And we believe inflation is going to be stubborn and stay around the 2.5% to 3% level, and therefore longer-term interest rates are going to be stubborn and stay around that 4 1/8, 4.5 level. Right now they're at 4.20. Short-term rates, the Federal Reserve Bank can control. Long-term rates, the markets control. So let's stop right there. Thanks for everyone for tuning in, and we'll be back in a couple of weeks with an update. Thank you.